All right, so everyone, thank you for joining us tonight. We're going to go through the LPL Research Midyear Outlook, and this one they've titled "Picking Up Speed." The one they had done for the beginning of the year was "Powering Forward," so I think it's the same kind of theme here with some race cars and that kind of thing. So I'll just share my screen real quick with you. All right, so. Without any further ado, I'll get started here. Like I said, picking up speed. The US economy was moving forward faster than really anyone thought that we were going to have in the first half of this year. The speed that it's been going at is kind of thrilling. The overall economic picture, it's still very sound, and it's going to support some profit growth probably with potential stock market gains. But the pace of the reopening may also create new hazards. So we have supply chains that are stressed, some labor shortages that have popped up, inflation is heating up, even at least temporary, and asset prices are looking expensive compared to historical figures. Okay. And in the outlook, we're going to cover the economy, policy from lawmakers, stocks, and bonds. So we're going to prepare for a fast-paced second half and take a look at some insights and guidance from LPL Research here. The U.S. economy has surprised almost everybody to the upside, and it's speeding along thanks to vaccinations, reopening, and record stimulus. All those things have combined to produce what could be one of the best years for growth ever. The growth rate of the economy might have peaked in the second quarter of this year, but there's still plenty of momentum left to extend above that average growth into 2022. As a result of the strides made towards reopening fully, the rapid vaccine distribution, massive stimulus efforts, and support from the Fed, we maintain our 2021 forecast for the US GDP growth of between 6.25% and 6.75%, which is a big jump up. And that really, actually, if you look at the slide, internationally as well, you've seen big jumps in GDP growth forecasts between last year and this year. And going forward, actually. Last year, we had a 3.5% drop in GDP, which is the worst year since the Great Depression. And it's honestly bounced back. It's kind of left in the dust 2020. And hopefully a lot of us are thinking, leave 2020 in the past as well. Globally, Europe and Japan have been slower to move past the pandemic, but explosive growth may be on the horizon once they do that. Meanwhile, emerging markets, which can be some Asian countries, some South American countries, continue to be a source of solid growth, with the Asian emerging markets being among the first to recover from the pandemic, even though growth in the US could be stronger. And this expansion that we're in now, even though it was a short recession, it could last a little while. Since World War II, expansions have lasted an average of 5 years, with the four most recent cycles going even longer than that. Before the pandemic, the most recent expansion was the longest ever, which was 11 years. And it honestly might have gone even longer if COVID-19 hadn't struck. However, this cycle may not be as long as the last one, considering that it wasn't your average recession, because it was the shortest ever recession, and the economy was supported by stimulus efforts that were historic in nature. Some of those imbalances that we would normally see in a recession didn't really get worked off, if you want to think about it that way. Corporate debt levels remain high. They're supported by low interest rates, and stock valuations also never really reset. The good news is that this new cycle of growth probably has enough going for it to be at least average, which would still give it another 4 years. So there's nothing wrong with being average in this case. Here we have a chart that it has a lot going on here, but it shows the US dollar in blue on the left side, and then there's the US twin deficit. And what they mean there is the current account, which is the US's exports versus imports. And when it's a deficit, it means that we are importing more. And then the budget deficit, we're in a deficit with it when it comes to the budget in terms of our GDP. And we think that this could be a source of weakness for the US dollar. The combination of, like I said, those imports versus exports, the current account deficit due to trade, and the budget deficit, it's a long-term driver that may continue to put pressure on the US dollar versus other major global currencies over time. During most of 2020 and early 2021, markets have been focused on fiscal policy due to massive government efforts to help the economy move past the COVID-19 restrictions. Policy does still matter, but it will matter far less to markets over the rest of this year. Markets may anticipate an increase in government spending if Congress passes some version of the Biden administration's Build Back Better initiative, but it's likely to spread out over almost a decade. The biggest risk might be around taxes, with businesses and wealthy households both facing the prospect that a higher tax burden to pay for that plan and to help manage the deficit. President Biden has proposed increasing the corporate tax rate to 28%, but we think that should be viewed as a bargaining position. And we think the more likely outcome is that we see the rate end up closer to about 25%. The negative news for the markets is that corporate earnings growth will take a direct hit proportional to that amount. Since the stock market is fundamentally driven by earnings, the tax impact is probably going to be a headwind for the stock market. On the positive side, this move, it's been anticipated for quite some time, and it really shouldn't be a surprise to the markets. Going another step, excluding the rate that was brought in through the Tax Cut and Jobs Act, this will still be the lowest tax rate in about 70 years. So historically, markets have absorbed higher corporate tax rates, although you do see below average returns in the market. While we don't think higher rates will be retroactive, they could take away some of the momentum from the recent surprises we've seen in earnings growth so far this year, and it may make the market a little bit choppier. Proposed household tax provisions that are supposed to raise funds for the Build Back Better initiative include increasing the top tax rate on ordinary income for people that were 37%, and it would move up to 39.6%. And capital gains and taxes on those who earn more than $1 million in a year to a maximum of 43.4%, which is currently 23.8%. So it's a pretty big jump there from almost 24 to almost 44. A fun statistic is that only 0.32% of the population makes more than $1 million a year. So the truth is that this won't really impact the other 99.68% of the population. Looking at history, capital gains taxes did increase in 1986 and 2013, but the economy was on firm footing, compared to the 1970s hikes, which saw the economy with higher inflation and slow growth. Not surprisingly, the two more recent hikes saw the stock market with more solid performance, but the 70s hike didn't really. It's as simple as the economy doing well, or is it not doing well? The policy matters, but bigger economic trends tend to matter more. Looking at stocks now, we expect the economic recovery to remain strong and to drive strong earnings growth going forward and support further gains for stocks. However, after one of the strongest starts to a bull market in history, stock prices reflect a lot of the good news already. As inflation pressures build and interest rates possibly rise further, the pace of stock market gains may be slower. So here's our market forecast for 2021, including stocks, earnings, and treasury yields. We do see additional gains for stocks in the later half of this year, but they're likely, like I said, to come at a slower pace and with more bumps in the road along the way. Our forecast for the year-end fair value of the S&P 500 is right around 4,400. Our forecast for the S&P 500 earnings per share this year is 195, which is above the consensus estimate, and that's a whopping 36% increase from 2020. And lastly, we see the U.S. Treasury yield, the 10-year, ending 21 between 1.75% and 2%. More on those yields in a little bit when we get to the bond section. Although no one would really argue that this cycle looks like any other we've experienced in recent history, when we study the second year of a bull market back through history, that can really be helpful. So when we look at all these bull markets since 1950, you can see over on the slide the average S&P 500 gain during the second year has been about 13%. If we focus just on the bull market that followed the decline of 30% or more, as the current one did, the average gain during the second year has actually been 17%, which would put the S&P 500 over 4,600. Now, as the bull market gets further into its second year, we would expect the volatility to pick up a bit. And also looking at the chart, the average maximum drawdown, meaning what the market is down to at its lowest during the year, for the index during those 2-year-old bull markets has been about 10%. You see that figure, that 9.8%. So given the boost from the reopening and the stimulus still working its way through the economy, pullbacks are probably going to be short-lived and corrections in the market are going to be less severe. Inflation and possible tax increases are probably going to be the causes of those corrections. Coming off a first quarter earnings season with probably one of the biggest upside surprises that we've ever seen, corporate America is definitely firing on all cylinders. Not only are their earnings expected to ramp up over the remainder of 2021 by quite a bit, but momentum is building as those estimates have risen so much this year. Our forecast for the S&P 500 earnings per share, like we said, was 195. We expect corporate America to build on that earnings performance next year and deliver 205, so 205 in earnings per share. That 2022 earnings number with a PE of 21.5 gets our year-end fair value for the S&P to that 4,400 mark that we were talking about. So that is quite a bit of numbers in there, but really it does mean that we expect earnings growth to continue to go up. Even as the economic recovery continues to drive revenue growth, there definitely are risks to earnings. Most notable for those would be inflation, which could hurt profit margins, and potentially higher taxes again. Despite the earnings rebound being so impressive, valuations are still on the high side compared to traditional numbers. The S&P 500 is trading at a forward PE of about 21 times the earnings estimate for the next 12 months. Everything after 1980 is usually an average of 17. So 21 versus 17 there. So a little bit on the high side. When you're incorporating interest rates to get a more complete picture, though we do find stocks are actually reasonably priced. To compare those valuations for stocks and bonds, we calculate what they call an equity risk premium, which compares the earnings of stocks to the earnings of bonds. And the S&P 500, being a stock index, generates earnings of 4.6%. The treasury yields around 1.4%. So the equity risk premium is over 3%. And that's above the long-term average of 0.8%. And what that really tells us, there's a lot of numbers, but it's really saying that stocks are cheaper than bonds right now. And getting to bonds, you see that they have their seatbelt sign, the universal sign for that, and safety. After one of the worst starts to a year for fixed income, which are bonds, returns might not get much better from here. Long-term interest rates have traded sideways and lower recently, but we expect rates to move higher, which would put downward pressure on bond prices. They do have that opposite relationship. Ultimately, investors should proceed with caution this year in the bond market. We're not giving up on it, though. We believe in high-quality bonds, as treasury securities historically have been the diversifier during times of market stress in stocks. So we think that's still the best diversifier if there are stresses in the stock market. So you might take a look at this slide and say, what does copper and gold have to do with bonds? I'll explain in a minute. Inflationary pressures continue to build as our economy continues to recover. And as one of any bondholder's main nemesises, inflation, it actually erodes the real value of the principal and interest payments you get, making them worth less. So while we don't believe inflation will be a lasting problem, we do expect higher consumer prices in the near term, and that should continue to nudge interest rates higher this year. We believe copper is an important commodity to watch. If we look at the chart, the ratio of copper prices to gold price is a pretty good predictor of where the yield of the 10-year treasury should be. Copper is an important input for a number of those consumer goods. So as copper prices have gone up due to the strengthening of the economy globally, 10-year yields have not kept up. While it's not a perfect predictor, the copper to gold ratio has been a fairly reliable one in terms of the direction that it's moving and the level of interest rates. And that would suggest interest rates could move higher from where they are currently. So what does that mean for your core bonds or your core fixed income returns? Rising treasury yields are a headwind to those bond returns. And if you look at the slide, the projected returns for that core fixed income, and that's looking at the US bond aggregate index, through the remainder of the year, they're pretty low and even negative in certain scenarios. The way to read this table is that if interest rates and spreads don't change at all, the index is projected to return around 1%. That's that 0.98 that you see in the middle. In a best case scenario, where interest rates move lower by 20% and spreads tighten by 20%. So if the difference between yields on high quality bonds versus low quality bonds, those spreads, if they tighten, which are both really good scenarios, they're optimistic, I should say, the index would return around 3%. So, you move left on that chart. In a more likely scenario, where interest rates move higher from where they are now and the spreads don't change, bond returns are likely to be flat to negative 1 to 1.5% for the last 6 months of this year. Because we think that interest rates have the potential to move higher from here, core fixed income returns may end the year with negative returns overall. That would actually be the first time since 2013 that that's happened. And it's negative total returns. Those don't happen a lot when you look at these types of bonds, but it may happen this year. And if we look at the bond math kind of quickly, as interest rates move higher, returns get better. So while this year might be disappointing, the future returns for those fixed income, the core positions, are likely to be better, although no guarantees, of course. So how should we invest in this environment? We still suggest that investors consider reducing the sensitivity to interest rates in their portfolios. Mortgage-backed securities don't offer the upside of corporate bonds, but they can be more resilient when interest rates are rising. Investment-grade corporates tend to be more interest rate sensitive than those mortgage-backed securities, which make them more vulnerable if rates rise. However, we think the short to intermediate part of the corporate credit universe makes sense. So we're looking at shorter term bonds, thinking that they're going to have, they're going to be less affected by those changes in interest rates. For suitable investors, adding more credit sensitive sectors like bank loans, preferred securities, emerging market debt to their portfolios may help them compensate for the reduced income potential. But we still think that high quality bonds should make up the bulk of any of the bonds that you own. So really, if you are really interested in income, then it may make sense if you need that income to get, some of those higher yielding bonds, but, everything in moderation, right? So if we're expecting treasury yields to be higher and low to negative returns for those bonds, why would anyone want to own them? Honestly, in case something bad happens that would cause the stock market to sell off. Core bonds, and more specifically treasury securities, have historically been the best diversifier to stock market declines. And if you look at the slide, when stock markets are down at least 3% during a particular month, treasury securities were mostly positive during that same month. You can see the stocks are in that dark blue or purple, a little colorblind, so bear with me. And the light blue is the treasury index. When you consider stocks are in the second year of a bull market, and historically that has brought increased volatility, core bonds might help dampen and offset some of those losses potentially, and keep you invested so you can work towards your long-term goals. We still definitely like stocks or equities over bonds over the rest of this year, but we think that bonds still serve their purpose in a portfolio. And if we look at the rest of 2021, it seems like, kind of the worst of times are behind us. We're kind of going full speed ahead. We do have a race car here, so that kind of really implies that. And we all really just want to take some time to enjoy the fact that the market is doing well after such a long period of caution. But really, these are also the same times when your planning is the most effective. So early in the economic cycle, with the next recession being potentially years off, we have this bull market kind of in full gear with a strong start, and really the market's been pretty calm. So right now, we would say is the ideal time to kind of take a look and review your financial goals. The planning ahead is going to be the most effective way to reach those goals. And if you take a look now and you're prepared for the market volatility that is down the road. So getting that early start right now, if we're thinking we're in the beginning of a cycle, very important. And then we have some great disclosures for you. So take your time if you want and read these. This will also be recorded and we can view it later if you really want to take a look more at these. But that is the end of our slides that we have today. So really now I just kind of want to open it up to everybody. If you have any questions, if there's anything that you want to kind of talk about a little bit more detail, I'd definitely be happy to take any questions from you. All right, so I don't think you guys have any questions. Nobody's inquisitive tonight. But really, if there are any, oh, Howard, sorry, let's see. Let's see if I can get you unmuted. I think you might just have to change your little microphone button to take it off mute.
No, thanks for that presentation. I think we're still, some of us at least, are still digesting all the material. That was a lot of numbers. I mean, it looks very positive overall, but man, it's a lot to take in at once. For
sure. Yeah, it really is. And you know, a lot of the times we don't go into the nitty gritty of a lot of this stuff with the exact GDP numbers and all of that. But really, since it is such a stark contrast to last year, it is kind of neat to see some of those figures and show you that, you know, they were forecasting growth figures, you know, 3% negative, and now we're at 5% positive, which is really kind of amazing to see right now.
I did have one question about the potential for a negative yield on the bond side. I mean, I never really actually heard of that before. So could you explain that a little further?
Yeah, so really, when we look at bonds, we haven't really had a situation where anything is yielding negative in the US anyway. If we look at international bonds, we actually do see some of their sovereign debt, so some of the debt like comparable to a US Treasury over in Germany, some of those other countries, they are actually experiencing negative yields. So you're almost paying to invest in their bonds. But really, the US, we don't see that happening. We see negative total returns. So that's largely due to interest rates. So interest rates moving up causes bond prices to fall. So when that happens, what we're going to see is that with interest rates already so low and what's going on right now, you're actually going to be buying a bond and you're still going to be getting the income from it. It's just that the value of that bond might fall. So it's kind of, you're getting a little bit of that behavior like you would with a stock somewhat, where you're looking at the value of it going up and down, whereas most people usually look at a bond in terms of the income they get. So all that volatility can still apply to bonds. Usually it's not nearly as volatile as the stock market, but we're going to start seeing some of that change in price, the value of those bonds, and it's going to tip it a little bit negative possibly for some of those. Does that make sense? I know it's a weird concept.
Yeah, it makes sense, but I also guess it like points towards your caution about, well, make sure you keep it like short term, because if you go too long term, boy, you know, it could be a bad deal for you, right?
Sure. Well, and if you look at it, like I would think about it as, you know, say you have a, I don't know, a plastic pole, and you kind of have it, your hands out, and you have it about 20 feet in front of you. If you move it a little bit at your hands, the end of the pole is waving all around. So if you think about bonds like that, the longer maturity bonds that you have, when interest rates move, they're going to have a really large effect. And if they're moving up, they're probably going to take the price down quite a bit more than if you had a shorter term bond just wiggling a little bit.
Right.
Yeah, so really we're very cautious about what we're looking at in the bond area. And if there are people that are looking for income, we're looking at a lot of other ideas, alternatives to traditional bonds as well to try to replicate some of that. But it's kind of a funky time in the market right now for that stuff.
So do you think then for people that are looking to move into bonds now, just because that's where they're at and, you know, in their financial planning, that there'd be more of a move from towards higher quality and less away from the higher yield bonds because of that?
I think you're always going to see a preference for more high quality bonds than you are higher yielding bonds. That's just the way that the risk works out. You know, your higher yielding bonds carry more risks for them, so you're going to have less of those. Kind of like with any stocks that you own or mutual funds that have stocks inside them, you only have a little bit of that risky stuff, and everything else is more of kind of a core holding. But really the bonds, I would say, you know, we've kind of talked about, they're almost a necessary evil. You know, you kind of have to have them to give you that stability. But really you're going to want that high quality because you know that those companies or the institutions are going to be able to pay that debt. You know, you're not worried about them going bankrupt. And that is a big concern with the higher yielding bonds. That's why they have to pay more in coupons, is because maybe their credit worthiness is not so great. And we would say that we're probably we would rather someone be a little bit overweight in stocks right now than they would before, just because with bonds, the outlook isn't so great.
The other thing that I saw, you know, nowhere in your slides at all too was, you know, the latest thing that's going on, which is, you know, all this push to try to get people into cryptocurrencies, you know, into some kind of investment that's based on that, which, I don't know, to me, that seems like, you know, gambling on, you know, highlight or something. But anyway, do you have anything or any thoughts on, you know, the impacts that these new cryptocurrencies and that kind of investment, making that available, might have as we're moving forward into this, you know, relative bull market?
Sure. So I will just say with the disclosure that we cannot recommend cryptocurrencies, but I would say that there is a lot of procedural stuff going through right now with institutional investment into that area. And really, it's another one of those different behaviors that we've seen kind of come up with kind of the gamification of the stock market. You see some of the traders, the new day traders that never really picked it up before, and now after COVID, they're kind of participating in sort of a more riskier way. I think the cryptocurrency conversation kind of falls into that area. Someone should definitely know what they're investing in. They should do their own research. But I think that for a lot of people that there may be other attraction to it, or they may kind of be seeing just a lot of headlines and really just saying like, hey, you know, did I miss the boat? Is this something that I should be in? Which tends to happen a lot, especially when the market's a little bit high. So I think it's a combination of things.
Yeah, that's what the people that are trying to sell you that are trying to convince you that, hey, you know, you're missing out. You know, this is a great thing. You could do really well here, make a fortune.
There's always a lot of issues when it comes around to, you know, any conversation where you might be missing the boat. You know, I think those are a lot of those are a little dicey, so you never know.
Yep, for sure. Well, thanks very much. Appreciate it.
Oh, yeah, you're welcome. Yeah. Howard, did you have your question?
Yeah, I wonder if commodity funds are advantaged in an inflationary environment.
Generally, I would say that any investment in real assets, so you're looking at something that you know, at one point in time, you could have held it in your hand physically. So, you know, you're looking at barrels of oil or other commodities like precious metals. You've seen what lumber prices have done this year. That's a real asset. Any of those kinds of things, those generally tend to be a hedge against inflation. Different markets can behave differently, but they are definitely something that's interesting, and there has been quite a bit of headlines about them recently. And I would say that between all of the real assets, real estate is kind of included in there as well, because those are physical buildings. Those are definitely something that a lot of investors are looking at right now, because it is something different that may produce income in certain scenarios. That's not bonds, or not something that correlates the same way to the market that we're seeing right now.
Thank you.
Yeah. All right. Do we have any other questions? I'll stop the recording here.